It's always like this with bull markets. They're unexpected. They surprise you. Just 6 weeks ago, after Britain voted to leave the European Union, stock prices worldwide suffered a two-day plunge of more than 5%. Political upheaval was sweeping the globe. China's economy was slowing, raising fears of a global recession, and terrorists waged attacks in Nice, Orlando, and Iraq, murdering scores of innocent people. That was the unlikely scenario just weeks ago, leading up to the latest leg in the long bull market run. Since the start of the year, the Standard & Poor's has gained about 9%. In just 8 months, stocks have gained as much as they historically have gained in a 12-month period. In July and early August, the S&P 500 repeatedly broke new all-time highs. When investors are fortunate enough to see the value of America's largest companies rise like this, it is more important than ever to focus on economic fundamentals to discern a bull market from irrational exuberance. While U.S. economic data releases have been positive for many months, July's employment figures indicate renewed growth could extend the 7-year-long economic expansion. The U.S. Bureau of Labor Statistics reported 255,000 net new jobs were created in July. The Establishment Survey of Job Formation, the red line, was confirmed by the Household Survey of Job Formation. Job growth was booming in July. The other good piece of news from the BLS was that the number of hours worked by Americans and their average hourly earnings rose by 2.6% over last July. That's a 25% jump in the annual growth rate in hourly earnings of 2.1% averaged since the end of the Great Recession. The two numbers we're talking about, wage gains and job growth, are the main drivers of employee compensation, and they account for the majority of personal income. Personal income drives personal spending, and personal spending is responsible for 69% of all economic activity known to the U.S. government. With very positive reports for July, the stock market is reacting accordingly. We're in one of the longest bull markets of the last century. A correction of 10% could come at any time, or market sentiment could suddenly turn negative due to some unexpected event. However, as of mid-August, none of the signs that precede economic downturns in the past were evident. Those who have derided the economy's slow growth are being surprised by the renewed signs of strength. Because markets always surprise you, regulators require that advisors for investments tell you that past performance of investments is not indicative of your future results. But that risk has a double edge, and sometimes you get a good surprise.